I'd argue this one's actually sort of better in some respects because there's been even less investment because I think there's sort of this narrative around oil going away, as well as a number of institutions and other sort of funding sources that were sort of there in the last cycles that aren't there because they have been told that oil is bad. So they're told it's going away, but they're also sort of, they promised to not invest. And so I think it might actually push this cycle longevity out. And so maybe this ends up as like a 10-year cycle instead of a 7-year cycle or something along those lines.
Think. Act. And prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome to the Money Level Show. Here we think, act, and prosper. This channel focuses on changing financial trajectories and building legacies. Today, I am joined by my good friend Benjamin from the ROI channel. His channel will be linked below in the description as we engage in this interview with Josh Young. Josh Young is the Chief Investment Officer and founder of Bison Interests. Bison Interest does a lot of research in the oil and gas industry. Josh has over 15 years experience in investment management, and 10 of those years come from the oil and gas sector. So today, we're going to get Josh's perspective on supply and demand, where he sees the oil and gas prices going, as well as specific companies where he sees opportunity lie. So without further ado, let's get to the interview. Hello, everyone. We are here. It is I and Benjamin from the ROI channel here with Josh Young, the great. How you doing?
Good. How are you?
Oh, doing well, doing well. How you doing, Ben?
Doing very well, thank you, sir.
That's good. That's good. Josh, so one question. I mean, you have, like, I started, investing in oil probably like a couple years ago, and I've watched some of your interviews. You provide a lot of high quality information. And I want to know, like, are we still early?
Yes. So there was a great chart from a Canadian investment bank that was posted on Twitter recently that showed sort of the trajectory of the last few oil and gas bull markets. And so if you exclude the 2009 to 2014 upcycle, which was very short and I would argue sort of got killed by shale versus what it might have looked like if it was like the other ones. If you focus on the other ones that were sort of more similar, I think, to today, where there wasn't some new technology that drove a huge amount of incremental production, you had these cycles last for roughly 7 to 8 years, which makes sense because that's about how much time it takes to start to realize that you're making a lot of money drilling wells and building rigs, and then to sort of order a bunch of them, start drilling too many wells, and then oversupply the market. So we're about 3 years in by that sort of same time frame. And if you chart it just versus those other cycles, there's still about a 2 to 3x for the index versus where we're at right now. Or I guess versus the 2 or 3x from the original point up more. So we could essentially double or triple maybe from here if it was like those other cycles. I'd argue this one's actually sort of better in some respects because there's been even less investment, because I think there's sort of this narrative around oil going away, as well as a number of institutions and other sort of funding sources that were sort of there in the last cycles that aren't there because they have been told that oil is bad. So they're told it's going away, but they're also sort of, they promised to not invest. And so I think it might actually push this cycle longevity out. And so maybe this ends up as like a 10-year cycle instead of a 7-year cycle or something along those lines. So yeah, I think the long answer, we probably have at least a few more years. Again, there may be some big economic disruptions along the way, but just purely from an oil and gas perspective, we still need to see that upcycle in activity. And we haven't really seen that yet. And without that activity, you're not really going to see a lot of incremental production. And so everyone, I think, is so gun shy, especially after that 2009 to 2014 sort of mini cycle. I think people are gearing off of that, it's recent. So there's this recency bias, but I think that recency bias is a big mistake in considering this. So long answer to a short question, we're probably early. We probably have at least a few more years. Again, it might be punctuated by some sort of economic downturn, but I think we have at least a few more years of upcycle for oil and gas, potentially a lot more than a few.
Yeah. Appreciate you sharing that because I was looking at the S&P holdings of energy companies. It's still pretty low, so we haven't seen a lot of big funds come in or pension funds or whatnot come in and accumulate a lot. Another thing, I was recently watching an interview with Ted Oakley, and he mentioned that in '77, that while the market, the rest of the stock market went down, and oil was just going parabolic. And so it's kind of interesting to hear that, because we normally hear the narrative that when recession comes, that oil just tanks. But right now, it sounds like when there's low supply, like it can stay elevated. Is that correct?
I think it's complicated. I think we were chatting about crude volatility before we started this recording, and I think that sort of framework. I think when you look at some of these economic studies, there's very little price elasticity of demand. Basically, the higher the price of oil doesn't really affect your consumption that much. But if you lose your job, you don't drive to work. And so we're sort of in a weird period because there's been so much work from home and we're starting to see return to office. So we're actually seeing a weird counter cycle. We're actually seeing an uptick in gasoline demand as people lose their jobs, because you're less likely, if you're listening to this and you're working remotely and you have an option to go into work, you should go into work. I mean, just like as a rule, I don't give very much advice, but this is good advice. Go to work, drive to work. And people are realizing this, I think, generally. And I've said this a few times over the last couple of years, and people thought it was crazy or were offended. But you should drive to work, because you're going to keep your job, and the people that don't are going to lose their jobs. People are figuring this out and starting to drive into work more. So there's this weird countercyclical demand. The reality is, though, if we have a 2008 style crash, we may see a step down in demand. It's not like oil demand would be immune. And so there is a risk, at least from a US perspective, of a step down in demand. It may be offset by international demand, it may not. So there's a risk. I was saying that it could get punctuated by some sort of economic downturn, but it would be sort of, up and then down a little and then up a lot sort of afterwards. And then the cycle would essentially be elongated and more pronounced if that were to happen, because that would be even further sort of disrupt the long lead time investment and activity necessary to get a lot more oil production. So we may experience a big drop in oil prices. We may experience a big spike in it before a drop. But I think just sort of the general trajectory, if this is like past cycles, which it does seem to be, would be up and to the right for oil for some amount of time, likely at least a few years.
Gotcha. And so a friend of mine, he works in the oil and gas industry and the rigging. I think he does drilling or something. And so he mentioned that the rig count continues to decrease. So many workers in that field are, concerned about if they are going to lose jobs or whatnot. And he's been in there about 15 years. And so he saw the last cycle of in 2008 and such. And he said a lot of new companies were coming on. There's a lot more competition during that time. And so, are we even seeing that now? It seemed like, because usually like in the bull run, you begin to see like, just very unwise investment, or a lot of companies trying to pop up in the space, whether that's like the .com bubble, or you could compare that to crypto, so it just seems like when there's a lot of capital and investment, there's just a lot of companies that pop up. And so are we seeing that now or no? Hello, everyone. Sorry for the break in action, but I want to tell you about the link in my description below. This is to the New Orleans Investment Conference. This conference has been around for years and have brought many people out, such as Milton Friedman, Gerald Ford, Alan Greenspan, and Margaret Thatcher. This conference is put on by Brian Lundeen and his team. Brian is the CEO of Gold Newsletter. This year, they're going to have speakers such as Jim Rickards, George Gammon, Peter Schiff, Rick Rule, Danielle DiMartino Booth, Lynn Alden, and many others. Now, I encourage you to click the link in the description below. You can choose to attend the live event, which I will likely be at, as well as the event that is live streamed. You can support the channel by using my link below, so I encourage you to check that out. Now, let's get back to the interview.
Yeah, so I was trying to think about how to parallel this to the tech crash and recovery. And the reality is that the oil crash and the oil downturn was so prolonged, it's not at all like the worst tech crash in the last 25 years, which was that sort of 2000 to 2003 time period. So if you took that, you made it 3 times worse, and you made it twice as long, that's essentially what we experienced with the oil downturn. And so the 2014 crash was sort of equivalent to what happened in 2000, 2001. But then you had a 2016 crash and then a 2018 crash, and then oil went negative in 2020. And so that'd be the equivalent of if there had been a giant tech crash in 2003 instead of a huge uplift, and then another crash in 2005 instead of another uplift, and then another crash, and instead you had just tech up and to the right. And so I think we've just, our recent experience with tech and with growth investments in this sort of long, low interest rate environment and falling interest rate environment for the last couple of decades has sort of made people forget, right? And if you remembered it too well and too soon, you missed out on this huge, huge run in tech. So this time is very different. And the easiest way to highlight it is using the framework that you were describing. There's actually fewer companies now. There's not a lot of new companies. There's a lot of actually old companies that are getting bought or closing still. And then we had, with this recent pullback in oil after the spike to over 100 around Russia's invasion of Ukraine, and then some concerns around Russian oil supplies getting cut off, we had sort of a double spike in oil last year. The rig count rose in the US by over 100 over that time frame, and it's subsequently fallen by over 100. We've also had a natural gas price crash, and natural gas and oil are sort of, they're related, and both will come from some wells, but they're sort of also independent. And so even though oil prices have rebounded substantially this year, natural gas has been pretty terrible. And that was sort of my forecast. I mean, people sort of hate when you're not bullish on everything, but I haven't been bullish on gas for a little while, and it's been sort of tough for a while despite really positive sentiment, I think. And so that's actually really hurt. I have a friend who's helps run a completion services company in West Texas, and he and I were chatting a number of months ago, and he was really worried about the price of oil. Oil had gone down to the 60s, and I pointed him to natural gas, and I said, hey, you want to look at natural gas? And then the West Texas local realized price, the Waha price for natural gas, and that was going to be a bigger driver, in my estimation, than the price of oil. And what we've seen is, even though oil prices have actually rebounded substantially, the rig count hasn't yet in West Texas. And I think a lot of that's that the local price for gas and natural gas liquids has been weak. And that may sound weird, right? Because they're drilling mostly for oil. But if you produce, let's say, 70% oil and 30% gas and natural gas liquids initially, if your sort of true full cycle margin needs to be at least 20% in order to invest, and not the BS internal rate of return nonsense that companies show in their presentations of 100% return or whatever. It's ridiculous. The actual return needs to be on a full cycle, fully loaded basis, roughly 20% or more for these companies to actually justify investing relative to just building cash or paying off debt or whatever. To accomplish that, you need to actually generate a profit. And if 30% of your volumes get a really low price versus 30% of them getting a really high price, that actually matters a lot in terms of the total profitability, and it really affects the marginal activity. So my suggestion was to point to this. That being said, there's a really high probability that over the next, let's say, 6 to 12 months, there's another 100 rigs added, just because you really need more activity. Well productivity has been falling, and the economics are, now that we're closer to $90 WTI than 60, the economics on a lot of these wells are competitive enough, even with low natural gas pricing. In the 60s, you really cared a lot about natural gas. As prices get high enough, if you're producing, let's say, 70% oil on your initial production for the first 6 months or a year from a well, at a high enough oil price, you sort of don't care as much anymore about that 30%. You care a lot more about that when your price of your primary product is lower. So I think, I know I may have made that a little bit more complicated than it needs to be, but you care about all three aspects. You care about gas, oil, and natural gas liquids. And based on sort of the combination of that, when the full cycle return is high enough, you see activity recover. We're very likely to see that activity recover. And another way to see that is that the oil field services stocks are starting to rebound, particularly the ones focused on onshore drilling and onshore completions. As those rebound, those sort of tell you that the market is pricing in, anticipating additional activity. And when you talk to the companies, they're expecting it both on the upstream side as well as on the services side.
Gotcha. Ben, I saw your eyebrows raise up. I felt like you may needed to chime in right there or something.
No, I have so many questions. Sticking with this theme of going from, say, the meso sector, working our way before we get into the micro, are you still putting a premium on those producers that have more of a liquids content, given the fact that we've spoken about in the past, particularly in the shale, the production's becoming more and more gassy? And if I was just reading recently about the actual energy content of a barrel of oil, a lot of that turns to gas anyway. Are you still putting a premium on those producers that have a heavy percentage of liquids? And what type of liquids are we talking?
Yeah, so I like to get natural gas production essentially for free, which is sort of what you're getting right now in the liquids rich gas producers. So in the gas producers, they actually trade at pretty high multiples, so you're still having to pay a decent price for their gas. In the oil producers, you're not paying much for the gas, but they actually, in many cases, aren't producing much gas. I like some of the companies that are, let's say, 50-50, sort of gas and liquids. And then my preference is if they produce oil, that's higher margin, higher revenue than the propanes, butanes, et cetera. But I think it's anything at the right price and with the right sort of return profile on invested capital or on return of capital. So it really just sort of depends on the specific circumstance. But where I am finding value, I think, is sort of in these more mixed companies where I think it's really hard for investors and for the market to sort of appropriately bucket them. And there's also some confusion. Like sometimes companies like you and I have chatted about Vital before, which I own and I'm not recommending, but they're sort of a mixed oil and gas producer, and their oil percentage has been going up, even though most of their competitors, the oil percentage has been going down. And so people have trouble processing this. I chatted with a guy who was short the stock at his multi-billion-dollar hedge fund, and his view on it was, they're terrible and they have low margins and they're a bad producer. And it's like, well, have you looked at their results the last few quarters? Oh yeah, but those are only a few quarters. And it's like, okay, well, let's look at what they're actually doing, not what they did 10 years ago with a different management team and a different asset base. And then let's look at the mix. Yeah, and the trajectory of the mix. And so, I think it's such a good question. And sorry to sort of take it on that tangent, but I think it's important because if you can shift or you can zig when others are zagging, sort of, you can actually create differentiated value. And the craziest thing is you can create differentiated value, or the company can be doing that. And me as I can buy that at a discounted valuation, not a premium valuation, because there's so many people stuck. I used Sandridge as an example where people hated that. And he hated that example because he said, it's a multi-hundred-million-dollar company versus a multi-billion-dollar company. But the reality is companies are companies, stocks are stocks. And it doesn't really matter if everyone irrationally hates a company that's a $500 million market cap or 300 million versus a billion. It's sort of, I don't know that it matters. I think it just matters that they're not willing to consider what's actually happening. They're not willing to consider a trajectory of change. And it's not like, for Vital in particular, it's not like I have to bet on them changing in the future. I just have to bet on them doing exactly what they've been doing now for almost a year and to keep doing it. And that ties back to the macro question, which is most companies, like you're saying, are producing incrementally more gas than oil because shale is gassing out to some extent. And what it takes is sort of unpopular, sort of dramatic actions like what Vital's been doing, where they come in and buy additional assets and ramp up additional production in different areas at some high initial cost in order to be able to get better margins, more growth, and sort of look different and sort of change their profile. And again, where that really comes in, when you look at the transaction metrics on buyouts of these sorts of companies, a lot of folks were pointing to this buyout of Earthstone, which was a multi-billion-dollar deal by Permian Resources, which is a very popular company, sort of odd. Texas Monthly, which is a very sort of far-left anti-oil and gas magazine, had just profiled the co-CEOs of this company. I mean, they're like around my age or younger. They're, co-CEOs, which is sort of a interesting, very low return historically profile for a business, right? You want like a person who's responsible. And so weird, like anti-oil magazine had just like promoted them. Anyway, they go and buy Earthstone, and people say, oh, well, Earthstone had this high oil content, therefore it would have been worth a lot more than Vital. But that's just not actually true. That was the narrative. That's the guy short Vital or saying that. And the numbers are, Vital is a little, I think it's close to 50% oil, and Earthstone was 45% oil. And so, the numbers are the numbers, but it's so exciting to get to own something when it's off the cliff, right? These guys are just wrong, and they're just not even bothering to refresh it. And then, they'll act on it. So they'll sell the stock or short the stock. And it's a really weird, and again, this doesn't tend to happen on, $100 billion type companies, because there's just so much money involved and so many people looking at them. But on this sort of smaller size, it's pretty cool to get to buy something when just the consensus is wrong. And again, getting back to oil versus gas, I sort of like these sort of middle ground type companies. And I really like the confusion around it, because there's a lot of money that's being made by some of these companies, and in both directions, right? Some companies are making a lot less than I think people expect, and some are making a lot more, and margins are shifting. And the confusion, especially by folks who are spending a lot of money on research and supposedly really understand this stuff and are taking in huge institutional capital to do it. I mean, man, it is exciting to be investing in a space when that sort of activity is happening.
So I was going to ask you if you still thought the value was in the small caps, but I think I may know the answer after that reply. So you're saying it's less of a liquidity issue for these big institutional funds. It's not that they won't go into the smaller companies because of a liquidity issue. It's just simply the fact they don't appear to be understanding what's going on and in production volumes, production breakdowns, and then valuation. Or maybe the co-CEO thought they were producing avocado oil or sunflower oil or something like that. I don't know. It's oil.
Hey everyone, sorry for the break in action, but I have to let you know that I am now an affiliate with Miles Franklin. Miles Franklin has been a bullion dealer for over 30 years, and they provide some of the highest quality service to their clients, as well as fair pricing on bullion products. So purchasing bullion through Miles Franklin not only stores wealth for yourself, but you're also supporting this channel to continue to provide free educational material for retail investors and those who may not be aware of many financial concepts that I discuss on this channel. So you can get started by sending an email to info@milesfranklin.com or calling 952-929-7006. Be sure to let them know that Daryl Thomas or the Money Level Show sent you, and I will receive credit for your service. I thank you all for considering this. Now let's get back to the interview.
Yeah, I'm not gonna. So there are really big differences in valuations on companies that are sort of in the $10 million or more trading volume versus less, just in terms of most of the institutional capital getting invested in public equities is getting invested through multi-manager hedge funds, like Point72, which is the old SAC Capital, or Citadel, or Millennium. And so they have enormous capital that they lever up 10x or 20x. So most of the money going into oil and gas on the long side or short side is through that. Particularly because a lot of the institutions that are allocating, I think, are just blinding themselves to that allocation actually being used to buy oil and gas stocks. It's sort of this weird thing. They're like, we swear we're not going to do this. And then they give it to a multi-manager who has like 12 pods all going and buying these same things that Bison's buying, but they'll buy the bigger ones because they can't go under this sort of volume threshold. So there's a big advantage right now in being able to invest at this smaller size. And people just don't, I don't know, it's very weird. They just don't seem to get it or appreciate it. You'll run into a lot of retail folks who are real excited. So individual investors are real excited about buying Exxon stock or about buying XYZ stock that's a 50 billion market cap. And just the odds of any of those things being mispriced based on current information are ultra low, because you have all these guys that really understand it. Where there are these mispricings is on the smaller side of where those funds can participate, where they're just not allocating the resources. Like the guy I was talking to, let's say he runs $1 billion, he might have been short 10 million of Vital, which sounds like a lot to you and me, but really for his business, it's just not, it's inconsequential. Not even worth really like refreshing the model and checking. They're paying for all this satellite data and all this other stuff, and don't really understand the business and can't appreciate the operational trajectory. And it's like, hey, and again, don't mean to like brilliant investor who's done really well, just not on stuff like this. When he and I have disagreed on these sort of smaller things, again, just resource allocation. But that's where the opportunity is. I think that size company and smaller, where there's just not that work being done, not that focus, and then where there's lots of sort of governance and other questions and issues. So I think there's still real significant mispricings. And then statistically, another chart I saw recently on, I think someone posted on Twitter from a investment bank, shows that small caps are statistically cheap in oil and gas, and that historically they were not. And so everyone says, oh, well, they should be because they are. And again, it's just sort of these weird, sort of no factual basis, sort of anti-intellectual arguments that you run into from allocators, from family offices, from fund managers. But you look at the data, and over the last 20 years, small caps and large caps and integrateds all traded around the same valuations from a like EV to EBITDA perspective.
That's interesting.
Sorry, go ahead.
Oh no, I was just going to remark on that because that is interesting, because traditionally you think of, okay, a smaller company has less economies of scale, let's say, and so deserves perhaps a lower multiple. But are you still in the camp of, let's say, what a Peter Lynch would look for, where he's looking for a company with earnings growth at a discount that can get those, he calls it a twin turbo factor, where you have earnings growth and multiple growth? Is that still going to be the case in these types of companies? And where do you think that threshold may be tripped? Will it be at $1 billion market cap, 1.5?
So I don't think you'll like the answer to this, but so yes, and there's a huge valuation dispersion right now. And historically, actually, small caps at this point in the cycle traded at a premium to large caps, because even if there weren't what you're calling economies of scale, there were huge advantages in being able to cost effectively grow production and reserves and cash flow. And so if you're Exxon, it's really hard to grow on a debt adjusted per share basis more than a few percent a year. If you're Vital, if you chose to, you could very easily grow 20%, let's say, debt adjusted per share per year on your existing asset base. You might not be able to do it forever, but you might have 7 years. I think their current estimate is 8 years at their current trajectory, sort of growing while paying off debt, while, or so top line growth plus debt pay down plus some extra free cash flow. And that's their guidance. And again, I don't want to get too much into the specifics, but just that idea, that sort of profile of company where they can grow, they can improve their oil mix. Sandridge, similar sort of thing. Again, I own it, not a recommendation, but that sort of small thing, those guys can grow way faster with a similar percentage of, let's say, cash flow being directed towards reinvestment, or free cash flow being directed towards reinvestment. And so historically, the small caps at this point in the cycle, where we've already seen sort of the commodity prices start to inflect, actually would outperform because they were better able to grow. And that growth actually deserves a premium, because if there is a scarcity in the commodity and there's a scarcity of growth, then if you're a producer of a thing that's scarce, that earns good margins, you actually should trade at a premium versus companies that have trouble growing organically. So that's what you saw historically, and you're not seeing it right now. And so, yes, exactly. It's a great opportunity. The re-rate seems to happen, unfortunately, at a pretty high size right now. So it seems like, so the Permian Resources Earthstone deal, again, highly accretive, sort of weird setup, again, because of who liked it and whatever. But as a combined company, their enterprise value looks like it's a little over $10 billion. And that's the point where you start to just see this re-rate. It's sort of getting dragged up towards a 5 times multiple. It was at a sort of 3 times multiple at a smaller size, and then you have the Vitals of the world that under 2 times EBITDA on run rate numbers at $87 oil. I mean, it might be close to 1 times. They have some hedges, but you pull those hedges out. I mean, just nonsensically low numbers. And I think the biggest thing is size. And again, you get back to the companies like Vital, where, okay, so they recognize that, so they grow their production organically and they go do acquisitions at low valuations, and people hate it. And it's like, well, you're just going to hate everything. That's fine. But these guys are solving this problem, and love it or hate it, short it or long it, sort of doesn't matter if they continue towards this $10 billion number, as proved by this sort of weird setup with like all this private equity overhang and sort of other hair. Permian Resources still, even with all that, even with high decline rates and whatever, still on that trajectory towards that 5 times multiple that the Diamondbacks and Pioneers and whatever are trading at. Some of those are even at a higher valuation than that. So it's sort of weird, and it's like you got to sort of turn your brain off a little to just say, hey, this is how the market is valuing companies of that size. And it should change, but unless it changes, that's sort of the path to a re-rate. And so you can hate it, but you can hate it while the people that are betting on it might make a ton of money as just it plays out over and over again. And then if you're too small and too cheap, eventually people come in and pay a premium. And that Earthstone deal was real exciting because people used, Permian Resources used stock, and it was a purely, it looks like stock deal. And, they paid a premium. It wasn't a huge premium, but then within a day or two, Permian Resources stock was going up. So Earthstone stock is going up even more. I think the stock's up like 30% or something since that announcement because of the combined effect of the premium paid and it being a stock for stock deal and it getting sort of Permian Resources above that $10 billion enterprise mark.
Now, I know,
So, go ahead, Ben.
Last one, then I'll hand it over
go ahead.
to you, DT. I know you're a fan of Mr. Buffett, particularly in his early career. For those factors that you mentioned in terms of the ability to compound rates at superior rates of return in the smaller sector, are these examples of the type of companies you think Mr. Buffett would be buying if he were running obviously a much smaller book with less restrictions around the size of companies that he has to buy?